Today, we're cutting it back to the basics. You've got a lump of cash to invest, say £10,000. What exactly should you invest it into?
The investing landscape has changed a lot in 2020, but the fundamentals remain the same as before. Savings accounts are a joke, investors are winners, and everybody should have an investment portfolio.
How should you invest £10,000 in 2020? We've got for you here a custom built portfolio of exactly what we would buy with £10,000. Let's check it out.
Welcome to Unshackled.com, the investment and finance channel and website that sets you and your finances free.
That was Andy and I'm Ben, and if you like what we say, hit the like button and click subscribe. Investing is not all about shares. We're totally going to be investing in shares. In fact, the stock market will make up the bulk of this portfolio. But investing is not just about shares. You need a range of asset classes in your portfolio.
First asset type, stock market ETFs. The bulk of this portfolio will be exchange-traded funds. ETFs are passive investments that track a section of the stock market, bond market, or commodity markets. They aim to match the market return, not beat it. In our case, we will be investing £7,000 or 70% of the portfolio into stock market ETFs on free trade.
The ETFs that we pick will be extremely diversified, allowing you ownership of thousands of stocks from around the world for a dirt cheap fee. Now let's run you through some options of ETFs you could buy. You can buy these ETFs on the free trade app, which gives you a free stock worth up to £200 when you open an account using our offer, linked to below.
ETF option 1, own the world with a single ETF. With over 3,000 holdings, the Vanguard FTSE All World ETF tracks an index of large and medium-sized companies from around the world. If you wanted a simple life, you could just have this one single ETF make up the entirety of the ETF allocation of your portfolio.
The US is the world's largest stock market, and the All World ETF recognises this by investing 57% of your money into the top companies of the United States. 8% goes into Japan, 4% into China and 4% into the UK, with the remaining 27% spread around the rest of the world. A big differentiating factor between ETFs and actively managed funds is the fee, with many ETFs being as cheap as chips, and we need that fee to be as low as possible so that our wealth can grow unhindered.
If you buy it on a commission-free app such as Free Trade, it will cost you nothing in broker commissions to buy and sell an ETF. But bear in mind that all ETFs have an ongoing charges figure and inbuilt fund transaction costs. These combined make up the total product cost, which is the cost of Vanguard to run the fund, a negligible 0.24% per year.
The ETF pays you dividends quarterly and has an annual yield of around 2.1%. Dividends are a nice to have extra on this fund, and we would reinvest them to benefit from compounding.
ETF option 2, control your weightings with multiple ETFs. Maybe you don't want 57% of your portfolio in the US, maybe you want more than 4% in the UK, in which case you might consider buying these 6 ETFs.
Here are the total product costs, which is ongoing charges plus transaction charges, all pretty damn cheap. Here is how you might split the £7,000 across these 6 ETFs. This portfolio would have an average total product cost of just 0.11%. Both options are pretty damn cheap for what you get, which is ownership of thousands of companies from around the world.
One advantage of holding several regional ETFs in your portfolio is that it gives you flexibility to weight it in favour of the areas of the world that you're most interested in. But it comes at a cost of having to rebalance the portfolio yourself every so often to get back to your desired weightings, incurring bid-offer spread fees.
Second asset type, commodities. Next, you want to own some physical goods so that you can conquer inflation. Commodities are basic materials like gold, oil, or even cattle that are the same wherever they are found in the world, and as such rise on average with inflation or better. The easiest and most liquid way of investing in a commodity is by investing in a fund which tracks the commodities market price.
We're going to invest £500 of this portfolio into gold. On free trade, we'll be buying the iShares Physical Gold ETC, which is an exchange traded commodity tracking the gold price. Gold is the original form of money, and it has been shown that it helps defend a portfolio against recessions, as typically this is when gold's value rises the most. When stocks fall during recessions, gold's price tends to increase.
We want no more than 5% of this portfolio to be in commodities right now, but as you invest way more than £10,000, you might want to increase that to as much as 10%. And in time, you can branch out into a wider basket of commodities like wheat, oil, or other precious metals, but gold will do as nicely as a starting point.
Third asset type, peer-to-peer lending. Peer-to-peer lending gives you a high interest rate of return by investing into fractions of loans. There are many peer-to-peer platforms to choose from, and ideally you'll want to invest across multiple peer-to-peer platforms to spread risk, but with just £10,000 it's okay to start with one. LoanPad is a platform that invests your money into commercial property bridging loans.
They pay you 4.5% interest, which is great compared to the rest of the market. And if you wanted to up your investment to £5,000, they'll even give you £50 extra cash when you sign up through the linked offers below. Peer-to-peer lending is great, but in the UK, there are rules which say that you should invest no more than 10% of your portfolio into this asset class, unless you consider yourself to be a sophisticated investor. So, for the purpose of our example, we'll invest £1,000 of our £10,000 in here. Fourth asset type, stocks. We have £1,500 left over from our £10,000 pot, and we're going to use this to invest in individual companies' shares. While buying ETFs is fantastic for diversification and makes life simple, you don't learn as much about the stock market as you do from investing in shares directly.
It's important to be able to exercise some creativity when you're building a portfolio, and we want to use our judgment about companies that we feel are well placed to beat the market, while recognising that this is riskier than funds by only having individual stocks make up 15% of our total portfolio.
This is where we need to let go of your hand a little and say that from here, it really is up to you. Of course, you may want to skip this step entirely and just invest more into ETFs. This section of your portfolio leaves the well-trodden path of high interest plus a bit of commodities plus a bunch of diversified funds and heads through the trees into the unknown. Danger lurks in this space, but also great opportunity.
For this part of the portfolio, you could use the Stake app, which has a massive range of 3,700 US stocks and ETFs to choose from, with commission-free trading just like free trade, and of course, a sweet sign-up bonus in the form of a free share.
You can buy a few stocks from the UK and other countries on other free trading apps, but because Stake has specialised in the US, it actually has a far greater range of US stocks.
This is where you can experiment and have some fun trading shares. Do you think that oil is low? Buy some oil companies. Do you think cannabis is the next big thing? Buy some weed stocks.
Become an expert. We've given you 85% of a ready-built portfolio which invests in high-interest peer-to-peer lending, inflation-beating commodities, and thousands of global stocks. These are just suggestions, and you should do your own research into alternatives.
The remaining 15% of your portfolio will be unique to you and is an opportunity to learn by doing with a relatively small amount of money. Question of the day: what shares are you buying and why? Let us know in the comment section. Thanks for watching. On this channel we talk about personal finance, investing, and all things money. And if you want to see more great content, please click the subscribe button below.
This is MoneyUnshackled.com. See you next time.